Hello, everyone. Good afternoon, I guess, as it is 12:02 Eastern Time. My name is Brian Overby. I'm the Senior Options Strategist at OptionsPlay, and I'm going to be doing the Growth Lab today. Tony's done the bulk of the Growth Labs. Going forward, we'll probably be doing a little bit of a mixing in between the two. And as always, when we start, we're going to be showing real securities. Want to make sure that it's not that you know that it's not meant to be a recommendation. Past performance is not a guarantee of future results. And well, I'll go right there. That's my name, Brian Overby. My X handle is at Brian Overby. My book is called The Options Playbook. And today we're going to focus on, well, we have earnings. Like, why not? We have Davos, we have earnings, we have political strife, we have, or I'm sorry, not political strife, geopolitical strife that is going on. And a lot of things are happening. So the markets obviously have increased volatility, but it's not necessarily being shown by the way the market has reacted. But not this week, but next week is when we're going to see a bulk of the Meg 7 stocks announcing earnings. We're going to see Apple, we're going to see Google, we're going to see Amazon. We had the kickoff of the Meg 7 with Netflix, which is, I don't think their earnings is as important as what's going on in the mergers and acquisitions space. As we see, Netflix is in the bidding war for Warner Brothers Discovery. They've upped their bid to an all-cash offer at this point in time. So that has drugged the stock down a little bit, and I actually think there's some opportunity a little bit in the Netflix space. But I'm going to start by looking at Tony's trades, and I do have the chat box opened up, and I do also have the Q&A box opened up. So if you have any questions, I'm happy to address them. And I'm not, if I'm doing something that's not quite the same as Tony, let me know. Or if there's something that I need to cover, let me know that too, and I will happy to try to address it. This is for the members of OptionsPlay, and that's why we're here. And we're trying to learn how to use the platform a little bit better, how to search for some trades overall, and also, some feedback if you'd like on the new way that we're looking at the daily play and the way that we are approaching those positions. I do think like the Netflix trade, the opportunity to maybe buy a deep in the money call option, something that we would call the stock outperformer. I think that's an interesting trade to do in that space, mainly because they're just out of the fold as far as all the big the volatility of everything that goes along with AI and this. They were the darling of the stock market until they tried to get into this bidding war for Warner Brothers, and the stock has sold off. But it's not a bad thing if they necessarily get it. You could say that, I guess you can make the argument that maybe they're paying too much for it. And that would be a reason to beat up the stock. But solid earnings once again, and they always seem to do well as far as their earnings report and the growth of the company. They've always been considered overvalued, but they continue to trade that. I think that since Netflix has came public, they've been considered overvalued. So they trade at a solid PE relative to the history of the stock. Okay, so enough said about that. Let's review a couple of these positions. On Airbnb, if we is a position that Tony has inside the portfolio, we'll look at I'll click close the position at this point in time, and we'll see where we're at. We're up 24% on that trade, 15 days remaining until expiration. The earnings is February 12th. And so a lot of times when it comes to the daily play, and me picking trades on a daily basis, and now we're looking to pick as much as 3 trades per day. It's hard at this point in time of the earnings season to find trades that don't contain earnings, right? So you have the volatility of the earnings, and I always want to emphasize that this is a risky time to be doing swing trades, and that's really what the platform is centered around because of those potential earnings events. So Airbnb, in my mind, is a really good short put spread. That was the strategy that I would like to do if I was looking at doing Airbnb. But then you throw in the fact that you have an earnings date before that expiration. Here it's February. So there's a February. So we're long to the February 6th expiration. We got February 12th. So what I would look to do on this trade on Airbnb, I was assuming we're going beyond the February 12th date. But we'll let this run a little bit. Let's look at the chart real quick. All right. So we had a strong bounce off the 20-day moving average. Let's go 3 months here. And here's the study views. Okay, so we got the 200. Well, here's the 50. Here's the 200. And this is actually considered a golden cross. It's not a very strong one, but it is good to always have your ducks in a row where we have the 50-day crossing over the 20-day. And obviously this was an inflection point in the underlying stock. And so now we're bumping up against the 20-day moving average. We've had 3 solid candles. And as of right now, we're looking like we're up on Airbnb. Okay, so great example of, and I think Tony's going to be back next week. But if we look at Airbnb, I want to roll this position before we get into earnings. Now, earnings is February 12th. I like the concept on Airbnb of doing a short put spread heading into that earnings. But we're up 24% with 15 days remaining. I wouldn't mind closing this out, even though normally we're looking for a double in the situation with Airbnb, up 75% at least. But expiration is approaching quickly. Our cost basis is 95 on our short option. I would look to roll this trade and buy this or sell this to close and look to roll it out. But I like what the chart is doing at this point in time. So I think by early next week, we're January 22nd right now. So we have all of next week, maybe even by Friday. I think I would want to take the profit off the table in this position and then roll it into a longer term position, which would include the February 12th earnings date, which is 21 days away total. That's the way my position and my view would be on it. Okay, I've asked several times for those of us less gifted than you and Tony to please include the trade entry box in the new daily play format. Hey, David, I did see that actually. That got brought up. So it is on the purview. So your question has not gone ignored, and Tony is aware of it. Tony would be in charge of the trade entry box, and I do think that it's going to happen. But I'm not 100% in control of it, David. But I did see your question, and it has been noted. Without a doubt. Rick, selling options through earnings. Do you like using iron condors or iron butterflies? Rick, that's a great question. And we'll look at a little bit of butterflies because around earnings, I do like butterflies. Now, I don't, and I guess this is my whole point, Rick, of my little poorly worded introduction is that the platform and just in general, we like to sell short spreads as opposed to buy long spreads. And it's hard to do that around earnings because of the risk reward. You have this known big event that is happening. And if you are wrong, you on a gap open or on a gap open to the downside or to the upside, depending on what your strategy and outlook was, it's hard to control that position. And to have the risk reward against you, like a short spread, makes it even harder to do. So sometimes if I'm looking at doing selling options, and we'll look at this, I did one recently in Goldman Sachs and around their earnings event, but look at a skip strike butterfly. That's an interesting trade to do around earnings. If you want to sell options against that earnings report. So if you're looking at doing a out of the money short call spread, right, to get bearish on an underlying stock, I like to think of skip strike butterflies, and otherwise some people, in my book, I call it a skip strike butterfly, but some people call it a broken wing butterfly. And if you like doing that, you don't bring in quite as much credit, but you're actually putting a hedge into the position. So I like to think of the skip strike butterfly as an alternative to a short spread, as opposed to an alternative to a butterfly, if that makes sense. And I will show you what I mean, and we'll look at a trade. I'll pull up we have a lot of over the next 2 weeks. About half of the companies, and I'm not exactly sure how many, but about half of the companies that are announcing earnings are going to be announcing. So we're right in the middle of earnings season right now. And more importantly are the Make 7, all the big stocks. NVIDIA always finishes up the earnings report. They're always the last one to report, and everybody, wants to be mentioned in every company that's out there is hoping that Jensen Huang will mention them in the conference call, because usually if you're associated with NVIDIA, that's a good thing for your stock. It goes back and forth. Sometimes they talk about the spend, but in general, that's usually a good thing, and they're always at the end of the earnings report. Okay, so I like that position, and I wouldn't mind, I'd consider rolling this one on Friday and rolling up and out. Stock is at 135. We're right in the, a little bit on the low end there. And so here's another thing that I don't mind doing on long spreads like this. If you get really wide too, you can always close this and take a profit and then go in and sell a new option a little tighter. But this is too tight of a market in order to look at that in the Airbnb. So Akamai, 57 days, up 55%, and I think they're announcing earnings too. Oh, long calls. Earnings on the 19th. Okay, so I like to talk a little bit about this, because this strategy, what I really like, where's this expiration? March 20th. I really like what Tony did here. Okay, and here's the reason why. And I'll be blunt. I didn't look at these positions until this morning, just so you know. But the reason why I like this trade is, if you are bullish, this is a $96 stock. This is a company that in the technology space, that as earnings approaches, implied volatility is going to increase, and you kind of see it right here in the IV ranking. We're up around the 60% thing. I expect that to percentile, but if I expect that to increase as expiration approaches. So if you are bullish on an underlying, I like to buy long calls that expire after an earnings report. And sometimes you can go into the platform, and the platform is really centered more around spreads, which is in most times is a normal case. But if I like an underlying, I don't mind buying, in this instance, Akamai, we're looking at the 90 calls, stock's at 96, buying a little bit in the money option contract that has time premium. I don't want to go to an 80 delta or a 90 delta. I don't want to go extremely deep in the money, because I do think that the one battle that you have with buying in the money calls, implied volatility and the potential for it to go down, you take that out of the picture, because more than likely implied volatility is going to go up as that earnings date approaches. Now, this goes all the way out to March 20th at this point in time. But we don't have to keep it until March, right? If we continue with this profit as that earnings date approaches on the 19th, well, then we'd look to close out the position. I would close it out on February 18th, for example, if I'm just looking at implied volatility in general. Or I would close it and roll it. And at that point in time, look at rolling into a long call spread, because now I'm going to have the opposite effect. After on February 20th, now we're more worried about implied volatility than we were to start. And so I really like this choice without talking to Tony or even looking at this. I really like his choice here with Akamai Technologies. All right, now Lulu is hurting. Down 50% on the position. $6, $3 cost basis. It's not quite at a position. Usually you're looking at doubling this, but we're having a strong day today on Lululemon. So here you would stay the course. And then we're up 50% on Cloudflare. Let's come in and look at that position. And I'm trying not to ignore. Okay, and I'm just reading a couple of these things. If you do have Q&A questions, please try to keep them in the Q&A box because I can keep control of them a little bit more. Yeah, we're reviewing them, Laura. I'm keeping one eye on the chat box too. And I will look at trades for ESI and HALO. Halo that Tony added to the top ideas for today. That's fine. We will do that. We will look at those trades. So this position might need to be adjusted. We have earnings coming up, I'm assuming. Oh, we got a bullish trade idea. Okay. Let's net flare this. See what has happened. A counter trend following. All right. Market has been beaten up a little bit, but position is still looking really good. One put verticals. What should we do with this? We're up 53 cents on the day. So we got bearish on this. Net is a bearish trade. Yeah, we're long that, and we got a bullish trade idea today. So we're up 50% on it, but we're long the put spread here. And the stock's at 170. So obviously we've done well. Now, cost basis on the 155 has gone from 366 to 670. And we still have 29 days remaining. We do have the bullish trade idea. You're tempted in this. Like, we're not to a point where we would normally do where we would close out the position. We want to be up about 75% on the trade. There's still a lot of room for this to run all the way down to the 155 level. So once again, I think we're right at this precipice. I don't like this. Just means that we're looking at a counter trend in this scenario. And let's go back and look at a 6-month chart. Here is our next support level. We broke below the 200-day. We got the 20-day moving. Oh, and here's. And we're getting a crossover here. Yeah, I kind of like the bear. I still think that we're down. This is where the next support level is, right around 158. I think we're going to stay in this position. Just stay in it. I don't think that we want to. I don't think we want to get out of this trade at this point in time, or roll it. We're up 50% on it. We did get the bullish counter trend, but we just broke. We've had 1, 2, 3, 4 days. So what the counter trend is saying is that we've been down hard, in the short term. And it kind of, I mean, to use an old analogy, you know, you're looking for a dead cat bounce in the short term. In other words, you're thinking that we've been down, 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 down. Eventually, we've got to get a little bit of pop back to the upside. And it has a lot to do with the momentum and that type of signal. And so, you know, you kind of expect this after quite a few down days in a row, and that will happen. Doesn't necessarily, it might be a reason to do a short-term pop trade on the upside because of it, but I like the way the chart is still looking. So we still got plenty of time. I think we're going to let that one ride. My question, okay, so that is bearish earnings calendar. Okay. Thanks for your explanation. I appreciate that, Rick. Would be out before earnings. Laura, is that in regard to, let's go back. Would I be out before earnings on the Akamai position? Is that what we're saying? And the answer is I would be out. Here's what I would do is I would reevaluate. If you got a nice solid profit, implied volatility looks to possibly increase as this date approaches. So I don't want to be in the long call. I don't want to have the risk of losing this profit because of the earnings event. So I don't mind staying in the position. The position still is bullish, and I think this is one of the undervalued stocks inside the watch list, and also in Tony's report. So it's still solid fundamentally in the space, and you got 57 days remaining until that expiration date. I would just do something before this date on February 10th. That's the way that I would approach that. Okay. Okay, so let's, I'm going to go back and look at a few of the trades, ESI and Halo. Okay. I think I addressed most of the questions so far. So let's go back to ESI. And I have the option trade ideas report here. So do a quick find for ESI. There it is. Element Solutions in the chemical space. ESI recently broke out above its 28 resistance level and strong volume while outperforming, providing an opportunity for further upside. Solid in the industry. Revenue growth is huge. And also earnings per share, net margins are solid. Okay. At a discount, significant discount to its peers. Relative, now the PE is the same, but relative to the earnings growth and the net margins. So I think if anything, I would highlight the net margins, how much better that ESI is doing as far as managing the company that's behind it. So what can we do in ESI? February 18th is that earnings report. Bullish and bullish, high volatility. Okay, so now you got a $29 stock. Go out we'll go 6 months. Pull this back a little bit. Yeah, it looks like we had a breakout to the upside based off of this high all the way back here. Had a pretty solid breakout. And we're continuing that breakout. All right. February 18th. You know what I would look to do? It's the same situation as Akamai in that we have an earnings date, and I'm highlighting that right here on February 18th. We got the IV rank medium right now at about 13 percentile relative to out of 100. So a little bit lower end. We still got 27 days until that expiration date. I like the concept of just buying a call. So we go, let me modify this. And it does bid ask, yeah, see, that's going to be an issue. I would think about just buying the stock at $2,976. It's not, and it's kind of the platform is highlighting that. I'm not quite sure what the bid and ask where we're at, but it's saying the site is saying that it's not liquid. So that's going to be a tough scenario. And this is an option trading webinar and an option trading platform. Because it's not liquid, I would think about just buying the stock and writing it into the earnings report. But that's not usually the case. So if we were in a more liquid stock, just even somewhat liquid, I would look to buy, this is not a bad call. $5 in premium, 57 days out. It's going to take you to the March 20th expiration, which if we go back to the portfolio, Akamai is the March 20th. Yep. Dang it. I did that to myself. ESI. I don't mind buying the stock. I like everything that Tony put inside the research report. I don't mind buying the stock outright, and I think that might be the play. Okay, but if you were looking to do the option, we're going to hit the mid on this. 25 strike. I like that. That's going to be, but that's going to be a little bit high delta. Yeah, I'm going to go a little bit closer to the money, but we only got. That's why it's doing that. We only have 5-point strikes, and that's weird. That should be 2.5 points. There should be a 27.50. That's the reason why it went down to the 86 delta. So we either got to buy an at the money. We don't get that option of buying of a just in the money. But the at the money option should have a little bit better market on it. So I guess this would be my recommendation. If I'm looking at buying an option and we're heading into earnings, we just had a decent breakout to the upside. 27 days away, we're going to buy a 60-day or 57-day option contract. And I would look to adjust this position before the February 18th earnings date. And another thing that you can do with this, if you are long that call, and I should have brought this up on Akamai too, is you can just sell a call against the position. On Akamai, I don't want to lose the gain that we have, and I don't want to go back because I don't want to lose this scenario here. But if I go to Akamai, I have a real solid gain. So I want to capture that gain in some way, shape, or form. What I would look to do, if the gain continues and the market continues to cooperate, I would look to sell the long call and roll into a long call spread ahead of that earnings report. On ESI, this would be a new position. We're looking at buying an at-the-money option contract, $1.58. So you can buy a lot of them. I'd like to go a little bit in the money, but we don't got that option because the strike price is just not there. And there's limited strikes because it is not as liquid. Solid, right? So one of the solutions is to just buy the stock outright. It's fairly inexpensive, but we're going to look at the option paying $1.58. If I get to February 17th and I have a small gain in it, maybe I roll it into a long call spread, right? And that's not even a roll. What it really is I just sell a call against my position. Implied volatility will increase, and that will benefit our long option, and then we'll sell some of that implied volatility increase and just keep it into a long call spread, which the platform likes to recommend to begin with, right? And I find it interesting, too, that you look at the OptionsPlay platform, and there is no optimal long call spread. And that's part of the reason because it's an inexpensive, lower strike stock, and you're really not getting much for selling an out-of-the-money option contract. So if we go, we're only paying for an at-the-money $1.58, going out 57 days. So here's the reason why it's not really adding that. Let's add a call, and let's explain the platform here, right? Okay. So 30 strike, let's even go up to the 35 strike. The next one that's available is 17 cents. Now, that's a solid move. You're talking about from 30 to 35 on a $30 stock, right? Your 6 points would be 10%, for example. That would be a real strong move. Stock came close, 22 to 29. So it's made close to that percentage move from the recent low to the recent high. So it's not saying that the stock can't do that. But you're only getting, well, 38 cents at the midpoint, 17 cents on the bid. It's just saying it's not worth selling it. I mean, that's simple. There's no optimal long call spread where you really get a huge benefit on your risk reward scenario by doing it. Not at this point in time, but I don't mind selling one as that approaches. Okay, so there's my ESI. Can you provide some on how to trade VIX? Yeah, well, the platform doesn't support it at this point in time. What we VIX quotes are proprietary, and you have to pay quite a bit to get them, honestly. But I'll give you some ideas on the VIX. Okay, and then so that's ESI. I answered the ESI one. Then the next one was Halo. Let's see where we're at with the liquidity. So we got the same scenario going on here in that it's not as liquid. We got earnings on February 17th. Wow, the vol is ranking is really low. So you're looking at buying a call again. That's what we're looking at doing. 26 days out. It doesn't, a little bit more expensive stocks, so it leans towards a little bit more relative on the vertical spread. I think what I would like to do on this trade, we got a CCI bullish dip. So and this is one of Tony's favorite signals, the CCI. It's a relative strength scenario. Is currently, and let's pull up the 6 month. I might think about, because if you're not as liquid, I mean, it's a catch-22. And that if you're selling spreads and you're correct on your forecast, you don't have to worry about getting out of the trade as much, right? Because if they expire worthless. We have 26 days away. So here's one thing that you could do with this trade. And sometimes this comes up in the daily play. And I get this question quite a bit from a lot of you that are out there. I've been doing the daily play for over a year now. Most of the trades, Tony always does pitch in and always helps out. But when we look at the daily play, sometimes I want to avoid earnings. And I think in this scenario, based off of the bullish signal that we just received, and the fact that we have earnings on the 26th and that it's not liquid, if you're looking to do the options, buying the stock is always, when it says not liquid, buying a stock is always where you'd like to lean. But you can come on in and look at selling, and it's going to give us a 0 as far as trades that are concerned, because you got to trade at the midpoint on this. You got to trade somewhere close to it. And as soon as you go to the midpoint, it pops up a score of 83, which isn't bad, but we're going to avoid that earnings. Let's see if we can do, 29 days. We're right on it. 26 days away, and there's nothing out. I guess I would stick here. I don't like the limited expirations and some of the things. But let's look at what the risk reward is so far on this trade. I'm looking for my calculator. 127. We're not quite there on the premium even, and that's because of where the vol is at. So 1.27 divided by 5. Tony's rule of thumb is it's got to be about 33%, or 1/3 of the risk of the spread. So we're not even getting that premium on it. So that leans us towards the bull call spread. And this is meant to highlight, and the platform does highlight, when it's not liquid, you got to be respectful of that. Yeah, you're paying $1 to get 5 here. So this is a real solid risk reward, and it has to do once again with the IB ranking. 57 days out, paying $1, break even would be 75. I don't want to buy the 70. We're selling the 75, buying the, I did it the wrong way. Here we go. Bullish, vertical, modify. Bet you it'll be close though. 6 and 1. We gotta do this. 395. Almost double. This is close. I'm not excited about this trade because of the options. We looked at I wouldn't mind doing a short spread that expired before the earnings, but that February there's only monthly expirations available, and the February. So this is a tough one. This is a tough. But the way that the platform is leaning is that you would go into a long call spread going out 57 days. This would be the trade. I think that is I would like to see this double. In other words, if the risk is 400, I'd like to see this be at least 800. So it's tough. I don't really like the way the options are priced here. 2080, get a little bit better. No, got a little worse. All right. Spending too much time here. The earnings calendar on OptionsPlay needs some serious updating. Okay. All right. I will address that, Emmanuel. Can you provide some info on how to trade VIX? If I was trading VIX right now, I don't quite have that in there. So let's look at CBOE VIX futures. In this browser, I usually have it highlighted, VIX volatility, VIX futures. I want to look at the quotes so that I can pull these up. It would be delayed quotes maybe. I apologize. VIX futures data, and you can find it. The CBOE posts it. I have it in there we go, VIX delayed quotes. I have it bookmarked in my Safari. And if you're trading the VIX and you're trading the VIX futures, okay, so I'm going to highlight this. I want to explain this page a little bit for the people that would like to trade the VIX. If I'm looking at the CBOE futures contracts, these are the weekly expirations. And to me, the ones that are not showing the last quote based off of those futures, those are weeklies and they're illiquid and I don't like to trade them. So if I was going to trade the VIX, I would trade this contract. And right now it's trading at 18, which I think is fairly priced. But we're going out to February 18th in time. The other day it was at 20 after the stripe about Greenland and going to Davos, everything that's happened. We've kind of waned a little bit as far as volatility is concerned, but I don't think 18 is a ridiculous amount. But that's where the market is at as far as the VIX is concerned. And I actually wrote an article inside my X profile called Decoding the VIX. And you got to realize that if you're trading the VIX, you are not trading the VIX index. You're not trading VIX. VIX is the spot. That's where the marketplace settles. So as expiration approaches, it becomes more of an important number. But to start with, these are the futures. So if we go all the way out to March and April, we're looking at the marketplace is looking at an implied volatility of 19. They don't move exactly hand in hand with the front month. And if I'm trading this and I'm implying that you want it to go to the downside, the way that I would look at this is either doing a long put spread, buying the 19, selling the 15, something like that. Or I'd like to do skip strike butterflies on it, or open wing butterflies. But that's too advanced. I would have to pull up a different option chain in order to show how to set that up. But I mean, if you could get it done for a decent credit, I would look at buying the 20 put, selling 2 of the 18 puts, and buying 1 of the 17. So you're 2 points wide on your long spread and 1 point wide on your short spread. And just consider that trade, and you would want it to finish below 17. Somewhere between 17 and 18 would be ideal, but if it goes below 17, you're still profitable. You have to get that trade done for less than $1. That was a lot. without having an option chain. So I apologize. That's how I would do it. If you want to read more about trading the VIX, decoding the VIX in x.com in my profile. Meta. Okay, I took a loss, exited the position, is up 28 today. Do you have any other suggestions for reading Meta? Was Meta did you buy the long deep in the money option? Westman? Wasim, I'm sorry, I apologize. My eyes aren't as good as they used to be. I can apply that one. Yeah, Mahesh, I agree with that. ESI is tough. It's tough to look at any of those, but if I were to do, like I said, if I'm looking at ESI, I mean, I think I'm buying the stock. I really do. When there's that low of liquidity, I'm looking at buying the stock, or I'm going to buy the at the money option, and that's the way I'm going to trade it heading into earnings. But you're right. That's open interest. When open interest is low or liquidity is low, there's no good answer. There just flat out isn't a good answer. You could try selling a put spread because if you're correct, it expires worthless. But I don't like that trade going into earnings. So I don't have a great answer, but I'm being brutally honest about it. Okay. Meta. Let's look at Meta. Meta's going to be announcing the first week in February once again. So we'll look at Meta. I think we ended up getting an alert the other day in Meta, and we did get this pop back up, and it was kind of a trend following to the downside. And Davos matters, right? And I'm not quite sure why Meta is up today. January 28th is the earnings. Okay, so we're only 6 days away on that, on the earnings. I think it's a Thursday. Is it a Wednesday or a Thursday? I'm looking at it right here. 28th is a Wednesday. But Davos, you're getting CEOs. I noticed Dell was up strong today. We looked at a trade getting bearish because we got a bearish signal, but Michael Dell came out, said a lot of good things, and the stock rallied based off of his interview, and is the way I really read it in Davos, and the fact that the market is just stronger. The market wants to bounce back from the initial losses from the announcement about Greenland. So if I'm here and I'm up 5%, I'm not 100% sure why Meta is up. I didn't catch that in the news bits that I read this morning. But what will we do with this trade now? But I do like that pop in the stock, and I do think that we received a momentum trade right down here, and this is obviously the recent low here. We got a gap up here, potential. They're looking to get in the energy space. Meta's doing a lot of things. They're just spending a lot of money. So there's going to be a lot of volatility in the marketplace. People have rewarded them for it, but then beat them up. So back here, they rewarded Meta for making that spend, beat it up, came all the way back, and now we're back in that same scenario where they're trying to basically buy power companies, buy powers to support their outlook on what AI is going to happen and everything going forward in the future. How would I trade this? We're right at, the 200-day just came down, got the 20-day crossing over. So right here was a little bit of a scary area in Meta, and then we got this bounce right here. Let's put in the trend line. Oh, we got the trend lines in, but that's not picking that one up. 583. Yeah, once again, the earnings report makes it tough. So, because of the earnings report, we're going to do a long call spread. 6 days away. If we're going to look at it today, relative strength is 2, which is strong. Volatility is here. So here's what we're going to look this, and we're getting a nice score on that too. So this would be our trade. 57 days. I don't necessarily want to go up pay that premium because earnings is going to be a risk. So I understand why the platform wants to go out 57 days, but we have a lot of opportunity in Meta. So I'm going to go a little bit shorter, and mainly because that earnings event is really important, and I'm going to be risking more per spread. Now I can manage my overall risk, but I don't necessarily need to go out that much in time to get that catalyst. 43 or even 36 days is fine when you have an earnings report in the middle. So we'll go with 43 days out. Meta has been in the research report for quite some time. So let's look at, but it's really about their spend. 640, we're going to have to pay up for this. 740 on the upside, 43 days out. 1,000, yeah, this is going to be an expensive one. $1,727. So if we're looking at a $100,000 portfolio, we're only looking to do one trade. Break even is going to be 57, $657 and some change. We're at 645. We're getting a lot of premium on the 680. So this 680 we can pull in. Pull that to, that's the highest strike we got there, 21, 40 points. Yeah, this one's tough too. We kind of need to give ourselves a little bit more upside, but we don't have the strikes available. 680. Let's see what happens if we do the 36 day. Yeah, see, our score gets a little better here. And here's the reason why, is we're giving ourselves, we're getting a little bit better. So that was a real good learning experience. Okay, and I'll be blunt. So I'm going in, I don't see the change, right? In the expiration on the 43 day, they don't have strikes above the 680. So the platform grabbed that. It didn't like it because the risk reward wasn't there. So if we go a little bit tighter, volatility is skewing. You got to pay more for the expiration that's close to the earnings date than you do for further out in time as far as vol is concerned. So if I'm here, I'm at 640 looking at 690. Now we're getting close to, it's still not great, but you're risking 2,000 to make 3,000. We would like this to be 4,000. So I guess but then we're going to have to pay up so much for it. Let's go down to the 20. Now we're at 102, and it's mainly because the risk reward is getting better. Gosh, I think this is the one. I think this is where we're at. $2,500 to buy one of these. Yeah, earnings just makes it tough. But this is the trade. This is the way that I would look at doing it. You're going to have to get a decent move in the underlying stock, but it moved 31 points today, which obviously, if it makes that move again going into earnings, this trade's going to be fine. And the at the money, let's look at the at the money straddle. Let's just pull up the strike. So let's add this one. Let's trade this. I should be able to add this to the I can't create paper trades. All right, I'm going to add it to my paper trading area. My Growth Lab is available, but I can't do that. All right. That's where I would be. It's tough because you're paying up so much for it, but that we're gonna go out 36 days. This is gonna be our new trade. 64, 146, 40. Trade quad. I don't want to spend that much. So we will do trade that. All right. We were at 25. Let's take this one and send this. I'll send it to my paper trading portfolio. I don't know why that went away. I used to have access to the growth portfolio, but I don't anymore. So I'm going to throw it into my paper trade. When I come back, we'll look at it. We're going to ride this into earnings. This is the trade I would do in Netflix. Or I'm sorry, Meta. I'm thinking of Netflix because I have that on my mind because I wouldn't mind buying a deep in the money call on Netflix. All right. Put trades on net. So net, we have a bearish outlook on net. Correct. Market is down. Added it. Yeah, net's done well. I think we reached our target on the downside on net, right? No, it's still in there. Orly was removed. Net bearish trade. Software companies have been beaten up. That's for sure. I don't know if it's rightfully so, but it is what it is. We got a bullish counter trend trade on it. And it's once again, it's because it's been beaten up so much. Broke below the 200 pretty strong, which is obviously a bearish sign. We do got the bullish counter trend. Oh, very weak. So I wouldn't lean. I would obviously wait, see if we get that dead cat bounce, which is the bearish counter trend, over the next couple of days. But if you wanted to do it, yes, earnings is February 10th, so you're looking at bearish, and we would be looking at the put vertical. And our trade would be 57 days out. Once again, you have earnings, so you don't necessarily need to pay up for all that time. $15 in this situation is nothing to sneeze at. So think to modify it, come in 75, sell the 130. Wow. So we got some big time vol in this, and go 43 or 36. Let's go 36. I like the 36 on Meta. See what the 130 is at. It's a 10 delta, so I think we could sell the somewhere around the 20 delta. Let's look at the 150 here, and let's look at the risk reward. 1,000. We're not going to do that. We're going to go 155, 145. Went the wrong direction. All right, so we're not quite getting the risk reward that we want on the trade. 112. I'm kind of surprised it's actually given that high of a number, but risking 1,000 to make 1,000, like you would if you're doing this running into earnings. The skew is obviously kind of hurting us here. That's part of the reason why the risk reward isn't that great. 1,200, so you would want to get around 2,500. 2 to 1 would be the ideal situation. If you're close, it's all right. But this is the trade that I would look at if I wanted to get bearish in this underlying. Buying a little bit in the money. I mean, we could buy the at the money. 170, save a couple of bucks there. See what happens then. Getting a little better. So probably the 170, because you're looking at 960, so that's almost 1600. That, yeah, I like this one better. Let's look at that. That would be the trade. 36 days out, almost a 2 to 1 risk reward. Sure, Mark. We can talk about Netflix. I do have interest in Netflix, and In a different podcast, I actually talked about buying a deep in the money option now that the earnings is over with. We still have a lot of earnings dates that are coming, and I think Davos is a positive thing for the markets because it's a sounding horn for all the people that are doing AI, and we're going to get more and more information on that. Now, there is obviously some risk that's involved with the merger, or acquisition, I should say, more than a merger, of Warner Brothers and the battle that they're having with Larry Ellison and just competing factors, right? So I don't know. I think if the deal goes away, Netflix might actually pop. People are more worried about the fact that Netflix is overpaying for Warner Brothers Discovery. And I think that is the reason why the stock, and that usually has, when somebody takes over, usually the company that is taking over the other company. But I do think that Netflix has always shown to have strong management, and their management decisions is part of the reason why the stock has fared so well. And so I think that this is an opportunity, the fact that it's been beaten up. Netflix. So let's look at that. And we don't have to worry about earnings. And so these are my struggles when I'm looking at doing trades around at this week in particular, because you're always dealing with the fact that most of the companies in the S&P 500 index are going to be announcing earnings. Well, in the NASDAQ too. So across the board, most of the companies are announcing earnings over the next 2 weeks. It's the heart of earnings season. And it makes it hard because you got to decide, is the risk worth, if you're looking at doing short spreads, is the risk worth taking around that known event when your risk reward isn't there? Right. And you have that, another alternative too is to look at ETFs. I wouldn't mind selling. The financials have came in, a simple trade, XLF is selling spreads on the XLF. I like this area. You're not going to get a lot for it, but here's you're bullish on XLF, mildly bearish bullish. Let's do this. Let's add this one to my paper trading portfolio too. High implied volatility. No optimal, really? Let's trade that. What? Yeah, you're not getting a ton. Oh, they're only going 1 point wide. Modify. 53 days out. Don't mind that. Let's go 4 points wide. Let's sell the 53 and buy the 59. I'm sorry, 49. There we go. 4 points is perfect. Uh, 50 cents. Not quite enough premium. Not quite getting the premium that we need. So the 50 going out 57 day, yeah, there's just no vol premium. 88 cents. We'd have to sell the 54. This is welcome to my world. This is the way that this is my process. This is the way I go through, and when we're looking at the daily plays and coming up with trades, I like XLF. I like the financial areas. In particular, I liked Goldman. We actually did a deep in the money call option on Goldman, did really well on it, and as part of one of the daily plays. Look at it, and I like this, but I just can't get enough premium. So now, am I willing to say I want to sell an in the money? It's only 6 cents in the money, but I'm willing to sell in the money option contract to be able to pull this off, and I don't mind that. 35 cents on the put side of things. This is a very liquid underlying. 0.88 divided by 4, 0.22. We're still not bringing in enough premium to make it worth it. So then you go back to just buying the XLF outright. Once again, you could look at a vertical. This wouldn't be bad on the vertical side of things, but the option play score buying, you understand why the platform is picking this. Once you start digging in, you can understand why it's giving the highest score to the 100 shares buying outright. And because once you start diving into it, you're just not getting enough premium to be selling that short put spread when you want to get bullish on an underlying. And I digressed a lot. I apologize. And I'm getting to the end of the hour. Okay, Netflix trade. Netflix, I like to go out 6 months. NFLX. Deep in the money call. I'd go to the June expiration. Modify this. And you're not always going to get a great trade when you go deep into money on the platform. The platform's more made for spreads. It likes spreads better than anything little bit out of the ordinary. And I think a deep in the money call option is a little bit out of the ordinary, not always traded at that level. We got an $83 underlying, modify. Okay. I'm going to look at the 80 delta. 78, 80, 71. We're at 83. Half a year out, June 2026, not quite half a year. 71 strike, almost to an 80 delta, 80 score on the I wish that would just say 80. Let's see what happens if we go to get close. I'm going to do the 71. I don't want to pay up. We could even do the 72 strike here. What I would consider is the open interest. It's whichever option contract had them. I don't have the open interest on this chain, but whichever option contract out of those two that were right around the 80 delta, I would use that option. I would trade the option that had the most open interest, because when you get deep in the money, bid-ask spreads are an issue. And this is the one that I would look to trade. Now, here's the thing. So, still got the IV rank fairly high. April 16th, 2024. You're paying $15, $1,500. Now, this is an alternative to 100 shares. And I always like to look at what is the total cost, because I'm doing this to try and manage risk on a risky situation. Vol hasn't necessarily came off, and it probably has something to do with the Warner Brothers situation, even though that they've already just recently announced earnings. So Vol is still a little bit sticky in Netflix, which is a little bit annoying. Okay, so if you bought 100 shares, you're talking about $83,040, $8,340, $8,340 to buy 100 shares of stock. We buy one option contract. That's $1,525 divided by $8,331. You're talking about 18%. Okay, so if you bought Netflix, could you lose 18% over the next 6 months just from buying 100 shares outright? The answer is yes. Do you want to lose 18% on anything? No, we don't. And my golden rule is usually on any stock that I'm trading. If I'm actively trading a portfolio, I don't want to lose any more than 7 or 8%. The William J. O'Neill, the thing from IBD from way back when, is always kind of stuck in my head. And so by trading this deep in the money option contract, I can make that fairly simple to do, in that if the underlying stock actually comes down and actually hits our strike, just be aware of that. That's just a kind of a point. But I also look at if this gets cut in half. So if this gets cut in half, $1,525, and we lose half of that, that would be 9%, right? And I would look to get out at that point in time. Odds are that that's probably going to be when we get close to the 72 strike, and you'd be selling an at-the-money option contract. So if you're buying deep in the money options as an alternative to owning the stock, it's very interesting in that as the market goes down, you lose slower. And as the market goes up, you win faster, you gain shares. So as we get deeper in the money, the delta is going to approach 1. Once it approaches 1, you sell the position and roll. You take that profit and roll. If it goes down, you lose half of your position. I want to get out. I want to keep my loss around 8% is ideal, right? I don't want to lose any more. If I get cut in half here, I'm going to lose 9%. And Now, overall, on the underlying stock, it's easy to lose that. But you also realize that you're still paying time premium on this. And you could even sell a position against this. But who really knows what happens on the bidding war? And I don't know if I necessarily want to sell a shorter term option against this because of what may happen. But look at our high here, 132 all the way. Now, is it feasible that we could get all the way back to there? Oh, and we got a counter trend that happened today. So once again, it's been beaten up enough that it created this counter trend alert. Yeah, I like it. This will probably, you know what? This will probably end up in the daily play tomorrow because we got that alert signal. So we're going to follow that alert signal. We already got rid of the earnings. I might just make this a trade, and we'll make it a deep. We have a lot of earnings dates that are around it. This will probably end up in daily plays for tomorrow on the growth side of things. All right, I got a lot more questions. Mark, do you understand that overall when I look at this? So it's an actively managed position. I get down to 20 days. I definitely want to get out before I get to 20 days because I don't want to have that huge rate of time decay as that approaches. We're going to start at 140 some days. Hopefully we get the movement to the upside before then. Thank you, Mark. Mark says very clear. Are there any short put trades on that? Yeah, you could do a short put trade. Short-term put trading on that. Oh, I'm sorry. But you could also sell a put spread on this. It's not a bad idea if you want to buy the stock to sell. You're getting enough premium here that selling a put to buy Netflix at a lower price is not that bad of an idea either. All right, got other stocks in here. Okay, I'm looking at the Q&A box, and then I'm going to call it a day. Meta had an analyst up. Oh, okay. Meta had an analyst upgrade, and I figured it was something from Davos, but all right. Thanks, Chris. I appreciate it. Chris says that Meta had an analyst upgrade today, and that's why it made that big jump. Everybody got scared when they said that they're looking to buy I'm going to get this wrong, but it has to do with their need for power and what they've been doing recently to acquire that power has been frowned upon by the marketplace, and that's what beat up the stock. All right, and Smith to everyone, can you explain the thinking on February 13th and 16th recommending the January 14th and January 20 calls? I did respond to that email. Okay, so this is a big deal. We're doing daily plays. We're doing 3 a day, and in particular when we talk about the protection strategies, if you own an underlying stock, some of the trades are going to be recommended as a covered call position, and that implies that if you own the underlying stock, you might want to think about selling a call against it, and then we might come back out and say, okay, if you have that position, that's fine, and then get an alert that says, okay, now we're really bearish. So then we end up selling a short spread against it. And we're going to be putting out, if we do 3 trades, and there's not always ones, we're not going to do trades just to do trades. So if there isn't a scenario that pops up or that presents itself. I mean, there's so many different ideas inside the platform, and then we can obviously whittle them down. Look at the technical ideas. Let's get rid of the counter trend following. Let's get rid of the not liquid. We can even get rid of the somewhat liquid. And these are, the plethora of ideas that have popped up. Citigroup is an interesting one too. Like I said, I like this space. Citigroup has done very well in their investment banking arm, and I like the companies that are doing deals. I like JP Morgan. I like Goldman Sachs. Goldman Sachs is the one I like the most, and Citigroup has benefited from it also. And that popped up on the bullish trade today. And bullish trend following. So this is, the marketplace has been strong. Let's keep with the trend. I digress. Can I explain that? So they're not supposed to be done concurrently, and I think that was what it just says Smith to everyone, Mr. Smith, that that is the answer. That if you do see, if you don't own the stock, you obviously don't want to sell a call against it, because that's what a covered call is. So if you don't own the stock, you can't sell the call. So an alternative to that would be to do a short call spread. And so sometimes you're going to get repetitive, and sometimes there's going to be a week where you say, let's do a short. I'm trying to think of. Oh yeah, yeah. UNH. UNH has done fairly well. Did a short put spread to get bullish on some healthcare stocks, and the stock is now up a little bit. Maybe we do a short spread again. In other words, you would close out the old one and you do a new one. You're managing your risk on your end of things, but just because you did the UNH trade 2 weeks ago and we got another bullish alert on UNH doesn't mean you should do the trade in this week, unless you got the profit. And maybe you should roll it then at that point in time. But you have to manage the risk on that side. You're looking at 20 trades a week. There's going to be some repetitiveness. I guess we'll leave it there. Thank you. Thank you for the comments. Great seminar. I appreciate that. Can you show how you would do that? With C. Okay. C's not a bad candidate for deep in the money options either. Look at an 80 delta. Look at June. Yeah, because we already announced on earnings. Don't like that it broke below the 20-day here, but the 50. This is the 50. No, it's not. You know what I would consider on Citigroup right here, based off of this alert? We've got vol at 18 on the IV ranking. I think that this is going to be okay. Yeah, 92, 43 days out. This might end up being you know why? And this came. So here's a great example. See, this is a perfect example of the daily play, right? I know that I did a trade on Citigroup. I know that I recently did one. I know that it is part of it. Now we got this bullish trend following situation, and I think we have we recently did a long call spread heading into earnings on Citigroup, I think. And now we have this scenario after the earnings event. IV rank is still sticky around 19. I just threw it into the play platform. We're given a 92 without even really thinking about it. Let's look at the 116 minus 109. We're looking at 7. 2.53 divided by 7. Yeah, so that's more than a third. That's 0.36 on the width of the spread. $2.50 going out 45 days. I like that trade, but this would be redundant. Mr. Smith brought this up, and all I saw in there was Smith for the name. But that would be redundant, right? Because a while back we did a long call spread ahead of earnings. Now we're looking at doing a short call spread. Why? Well, there's no earnings event. And we got a bullish trend following signal. So now we're going to come back to say, and if you didn't do the long call spread, because we can't assume that everybody's doing every trade, well, we want to draw your attention to this. And that literally just popped up from clicking trade ideas and bullish, right? The only thing that's a little bit tough here is that the relative strength, we're on the higher end of this because it has, if you go at the 6-month chart, I mean, it's been parabolic. This has actually been one of the, and it just was always one of the more undervalued stocks. Yeah, and you can see the pullback. Yeah. But Citigroup's done really well over the last 6 months, even the last year relative to the rest of the financials. And it used to be the one that always got taken out to the woodshed. But they've done really well, and once part of their growth is the mergers and acquisition wing. They think they were up 32%. They announced year over year on fees in that department. All right, everyone. Laura says 18 seems low to me. Yes, it's low, Laura. So I should address that. It's low relative to an earnings season. It's not low necessarily after an earnings report. So I'm guessing vol is somewhere around 30%, which isn't low in the city, but I'm guessing that's about where we're at. Now, I gotta go. I'm getting down the rabbit hole. I've been on way too long. All right, thank you, everyone. Yeah, Laura, around earnings, that would be low. During the regular trading session with no known news events, it's not bad. That's, I guess, the best way I can say it. Everything is relative to earnings, and it makes it very hard doing daily plays these 2 weeks in particular, because you have an idea and then you're like, is it worth the risk around earnings? And I'm not 100% sure if I really want to sell a short put spread and get bullish that way, but we have earnings, so do we do it and take the risk of the earnings report? Because there is a risk. There always is. All right, thanks everyone. Thanks for coming, and I think Tony's back next week, but we haven't solidified that. If not, and then I'll get this fixed. I used to have access to that growth portfolio. I'll make sure that I have access so I can put them inside the growth lab portfolio. I apologize. They're going to have to sit in my paper trading watch list for now. Have a great day.